Okay, well, Nathan Sheets is now joining us, Global Chief Economist at Citi. Nathan, great to have you with us here. Good morning. It's always a pleasure having you with the CNBC-TV18. Let's just start with the CPI number last night. So, we had 2 months of pretty soft number, and the latest data indicates a bit of an uptick. How do you read this, Nathan? And what does this mean for Fed action next week?
I think it was a bit stronger than what the markets were expecting. I think a lot of that strength was in airfares and motor vehicle insurance. So it's fairly concentrated. But even with the upside surprise, if you take it out several decimal points, it was still a bit softer than a 0.3. Hardly where we were 3 to 6 months ago, still a softer pace of inflation compared to the recent history. A little bit stronger than the last 2 months, though. But taking it all together, I don't think it significantly undercuts the case that the U.S. economy is in the midst of a gradual disinflation. And I think that's what Jay Powell and his colleagues will see when they sit down for their meeting next week, that the inflation rate is moving down. It's still much higher than they want it to be, but it's moving in the right direction. The labor market is gradually cooling. So I think that they're going to see an economy where they've hiked significantly. And the medicine that they have administered is gradually taking hold. And I think that they'll be able to watch and wait at their September meeting, and then ultimately have a really serious debate in November as to whether another hike is necessary or not. But I think in any event, they're coming very close to the peak of this cycle.
Okay, so expecting a pause in the September. On that point about the core CPI, the month-on-month increase in the month of February was 0.5%. Then in March, April and May, the core CPI went up by only 0.4%. And then in July and June, it was just a 0.2% increase, which again inched up a bit to 0.3% in the month of August. But again, it's still not at those 0.5, 0.6 levels that it was at the beginning of the year. Nathan, thank you very much for joining in. This is Reema here. You were expecting a U.S. recession. Well, so far, the economic data coming out of U.S. has been very, very strong. So where do you stand on the U.S. recession bit? And, on November, where the street is still divided, would you want to give in your opinion? Do you think they will hike or will they pause?
Well, on the recession call, where we stand is frustrated. Our sense is that when the economy's been this hot, when the unemployment rate's this low, and even now with inflation lower, it's still higher than the Fed wants, that ultimately the unwinding of that tightness in the economy, at least historically, has always entailed a higher unemployment rate and a recession. And we continue to cling to our recession call, and we're expecting a mild recession, a mild downturn in the first half of next year. But as I've described, these data are gradually slowing. And the question is whether we can continue to see that happen and eventually just kind of soft land into that kind of 2% range the Fed wants, or if ultimately we're going to get stuck. And specifically, non-shelter services inflation, which is critically tied to the labor market, hasn't improved as much. And do we get to a point where to get improvement in those core services that we're going to need the recession? It's very much an open issue. As I said, we continue to lean toward recession, but it's been pretty frustrating so far this year. And then consistent with our narrative that we think there's a little bit more juice left in this economy, we lean toward thinking that the Fed will hike in November. But I think it's really important to not get too focused on, is it one more 25 basis point increase or not? The key point is the Fed has hiked over 500 basis points. And whether they top out a little over 5.5 or where they are now is really second order to the fact that they've hiked dramatically over the last year and a half.
Nathan, hi, good morning. Good to have you on the show. So, what does it all boil down to? What is your base case for the U.S. economy as we head into 24? And for us, we are more keen to know what is the takeaway for emerging markets like India? Because, here, the market's going great guns. I think the only risk that we are hearing here locally is, hey, hang on, if the U.S. starts slowing down, if that market starts faltering, the economy and the market, then our rally could hit a speed bump as well. So just trying to take some clues to get to that answer.
So our baseline is pretty solid growth through the third quarter, a bit of slowing in Q4, and then a couple of negative quarters and a rising unemployment rate in the first half of next year, followed by a bounce in the second half. Now, if there's any good news embedded in the recession, and specifically good news for emerging markets, it's that as the recession begins, that should open the door for the Fed to start cutting rates. And that is our expectation, is that the Fed is going to be cutting at a pace of 50 basis points a quarter starting in the second quarter. Now, notably, if the U.S. is in the soft landing, then in terms of growth, I think that's good news for emerging markets. But the flip side of that is likely that if we're in that soft landing scenario, the Fed is likely to keep rates higher for longer than if we're in a recession. So when I think about the impact on emerging markets, the soft landing, I think, is better on the growth side of the ledger, but ironically could actually be more challenging on the rate side of the ledger because the Fed is just not going to be able to cut as rapidly as if we have the recession.
That's a really interesting, observation, Nathan. So just for clarity, right now you're working with a 50 basis points cut every quarter, starting second quarter of calendar year 24. Did I catch that right?
Exactly.
Wow.
So we see the Fed funds rate peaking in November at about 5.6, staying there until roughly April, and then by the end of next year would be at about 4.10 on the Fed funds rate, with the recession embedded in our narrative.
Okay, just 30 seconds, Nathan. But do you think they'll cut all the way back to near zero, or you think this time it'll be, we won't get to ultra low rates?
I think Jay Powell is hoping with all his heart that he's able to stop at something like 3%, maybe even 2.5%. And I'm hopeful that we won't see zero in the United States for a while to come.
Well, I don't know if it's a good thing or a bad thing. I mean, zero rates have been, we're used to a 0% world, right, for the last at least 10 years now. So, well, we'll see. Thank you very much, Nathan. Great to have you with us here on the program. It's always a pleasure speaking with you. So that's the global chief economist at Citi with some perspective on where the U.S. Interest rates, risk-free rate, etc., are going to be later this year and by next year. We'll